Hey, what's up everyone? Welcome back to my world of stocks. Now, in the last video, we talked about how the market is really struggling right now because of tariffs. Well, guess what? When stock prices are going down, dividend yields go up. So market downturns like this are actually some of my favorite times to be hunting for some great dividend stocks for the long term. And that's exactly what I'll be showing you in today's video. Now, there's actually 6 dividend stocks that I'm actively buying right now that I'm very excited about. But that's a little too much for one video, so I'm going to give you 3 in this video and then a bonus 3 dividend stocks in the very next video, probably out tomorrow, maybe the next day. But I already have that pretty much all set up and ready to go, so that'll be out very soon. Make sure you subscribe for it. But for today's video, I've got 3 dividend stocks here yielding well over 3%, 4%, and the last one is even close to 7%. So these are monsters in the dividend space. I absolutely love them. They're at a great price right now. They've fallen a lot, and I can't wait to share them with you. So let's go ahead and jump straight into it here. Now, dividend stock number 1, it's a very easy pickup for me. It's in Tyson Foods, ticker symbol TSN, who I just think really any unbiased, logical minded person would want to own this market leader long term, as they consistently hold #1 market share for meats in America and even #2 in the entire world. They're the second largest in the world. That's pretty crazy, guys. And the great thing about the meats market is that it's not likely to ever go away. Now, I know that there is a rise in plant-based alternatives right now, but even there, Tyson also offers many of those products too. So you're just not going to really find a way to get rid of this type of company with so many strong brands under their belt. And yet, it's still a business that can actually be heavily impacted by the state of the economy and inflation and interest rates, because when all of those things are bad, well, it can not only hurt their sales, of course, but it can also raise the price of feed, which is really important in the meats market. And so inflation is going to send, the price of feed up. That thing, whether it's grains or corn or any other whatever feed that you're feeding to these animals, what these animals eat. Well, that's going to end up hurting TSN's margins because they have to pay for that. And it's actually already caused them to lose money on the bottom line in 2023. But because of those effects, this is actually a very, cyclical type of business here, which we can see reflected directly in the stock price. Now, here's the past 10 years, for example, and you can see all of those big dips coupled with large rises too. Well, it just so happens that right now is one of those major drops. And if there's anything that we know about cyclical type of stocks like this, it's that, typically the best time to buy them is going to be during one of those major downturns, like the one that we're experiencing right now. Now, it doesn't mean that it's not going to, that it can't keep falling from here. Obviously, the state of the economy is not too great at the moment. Inflation and tariffs and everything else weighing on consumers and the economy. There's also tariffs, all these things going on at once. So, and I forgot to say what interest rates. So, the price could still be headed lower, but the point is that longer term, this is a stock that will probably recover. I mean, it's something that we've seen in history, throughout history, and it's something that I think we'll likely continue to see well into the future because of the type of business this is and because of the market that they operate in. Like, meats is super important. You can't go without, food, right? People need to eat. So it's just not something that can ever disappear. And that bodes very well for a cyclical type of stock for it to actually be able to recover. And by the way, that's exactly what analysts, all the professionals, all the economists out there, well, all the analysts anyway, that's what they're expecting. They're looking at sales now stabilizing and profits. They're expecting them to grow quickly too here, back up to healthy levels in the coming years. So everything is actually looking pretty good moving forward for future years. But because investors, my honest opinion, investors are just too short-term minded, that they kind of miss the picture here. And because of that, they keep the stock very low the major crash that we've seen in the price, and that's caused the valuation to also be dirt cheap, which I just think that they're ignoring here because again, they're just so short-term minded. They can't look into the future and see that this is a stock that could easily recover. But because of that, you've got a 65% lower PEG ratio than the sector median, despite this being a market leader. That's how they're that much cheaper than the rest of the sector. I mean, it's crazy. And best of all, the dividend yield has now risen up to over 3.3%, which is one of the highest levels that we've ever seen from them. Again, for a market leader like this with so many popular brands and at that price and with that dividend, I'll take that whole package, all day, and I'll take it at that price while I still can. All right, guys, moving on to dividend stock number 2. I am loving the shares that I am getting right now from this company here. And this one is a company called Scott's Miracle-Gro, ticker symbol SMG. They're the world leader in garden and lawn care products. And it's a stock here that I am once again getting super excited about because really what we've seen now is a giant crash from the top, leaving behind a monster dividend with a dirt cheap valuation, pun intended. But you look at it here, the stock has lost more than 75% of its value coming off the pandemic. That is a monumental crash that we're talking about. And really that's because during that time, everyone was staying home, doing various home projects, renovations. Plus there was a lot of hype in the can market, which SMG also supplies. But coming off of that, the can market crashed and we've been hit with giant inflation and interest rates that weighed on consumers who chose cheaper alternatives, thus hurting SMG sales and margins, resulting in very tough comparison to prior years. However, it really looks to me like they've hit the bottom here, and they will likely start to bounce back over time as analysts across the board are projecting a return to growth on both the top and bottom line in future years, with sales even surpassing what they were before the pandemic ever even happened, despite the stock price still being less than half of what it used to be during that same period. Now, to me, guys, that makes zero sense for what is also just like Tyson Foods, right? This is also a market leader here, and they also happen to have, the highest quality of products in their respective market too. Like their brand is extremely strong. Everybody that does home and lawn care stuff, they of course know about Scott's Miracle-Gro. Now, considering the cheap valuation, you're talking about a PS ratio below 1 and a PEG ratio of only 0.7. That is less than half the sector median of 1.5. And you've got a mouth-watering dividend now that has risen to about 4.4%. It's among the highest levels it's ever been. Well, you can be sure that I am buying this one too. It's one of my really favorite stocks at the moment. All right, guys, finally, dividend stock number 3. We actually have a bit of a more controversial type of pick here, but I'm buying more Pfizer stock too. And here's why. Now, ever since their pandemic highs, where they made unbelievable amounts of money from the V shot, and they grew to literally become the biggest pharmaceutical company in the entire world. Well, investors have completely abandoned this company. And look, whether you agree with them morally or politically or anything else, if you just look at this from like a more objective kind of business and stock price perspective alone, it is shocking how much this stock has crashed from the top when you consider, of course, how powerful they still are as a company. Well, you can see that on this chart here very clearly. They've now lost over half of their entire value from the top, and they're trading 22% lower than they were an entire decade ago. And that's caused the valuation to have now fallen to around 50% cheaper than the sector, again, despite them being a market leader, just like the others that we've talked about so far. And all of that has resulted in the dividend skyrocketing. It's approaching a monstrous 7% yield. It's almost there. And that's also among the highest levels that we've ever seen for this company. It's a huge dividend. Now, again, there is a reason for this. In 2023, for example, most people stopped taking the V shot and the pepperoni was just not really a thing anymore. So that resulted in their profits evaporating while their sales got cut by almost half, all of which correlates almost perfectly with the decline in the stock price. However, here's the crazy thing, just like the other two stocks that I showed you, what investors seem to be, kind of ignoring here, at least the short-term minded ones, is the fact that this year Pfizer will literally generate over $20 billion more in revenue than they did before the pandemic ever even happened. And they'll generate more earnings per share too, while the stock price continues to sit around 40% lower than where it was back then, regardless. And on top of all of that, investors are also kind of ignoring here, or maybe not realizing, is how much unbelievable amounts of money Pfizer generated from that V shot that they have now used to finance $70 billion of new acquisitions. And that's to bolster up what is already one of the biggest pharmaceutical pipelines in the entire world, and one that will, only continue to grow larger over time because of those new companies under their belt now. In other words, the stock seems to be at a very deep discount at the moment. And, maybe it's for good reason. Again, it is a very controversial company these days. Some people really like them, others really hate them. But putting any kind of personal feelings aside, I just think it's at too big of a discount here, from a stock perspective alone, for me to ignore. And so because of that, it is a stock. When I look at the business side, when I look at the valuation, and when I look at the dividend, man, it makes sense as a stock investment. But anyway, hey, those are just my, quick kind of opinions that I've got for you on these stocks. What do you all think? I'd love to hear your thoughts down below. Again, all opinions are welcome down below. Of course, be respectful and nice to everybody, but I welcome all thoughts and opinions. I'd love to hear your thoughts. If there's any other dividend stocks you think should take the place of any of these, let me know down there. I might include them in a future video. But hey, thanks again for stopping by, my friends. Thank you for all your support. And again, don't forget, I've got a bonus 3 dividend stocks coming very soon. So make sure you're subscribed. But I'll catch you in the next one, guys. I hope you're all doing well out there. Take care, my friends. Bye-bye.